Good morning and good afternoon, everyone, and thank you for joining us. We have over 70 participants across 18 countries taking the time to join us today. We felt this was an important focus in terms of lending, digitization, and how to transform lending processes. This is the first in a set of credit and risk webinars that we'll be hosting, but equally we'd be interested in other topics you may be interested in hearing about in the future. My name is Damien Burley, and I'm the Chief Revenue and Marketing Officer at Acuity Knowledge Partners. For those of you that don't know Acuity, we are the leading provider of offshore research and analytics, servicing over 300 plus global financial institutions. We have over 3,000 financial services subject matter experts, and as a firm have 20 years of expertise in lending, credit experience, and transformation, and making safe and secure trusted partnerships for our clients. We have experience across every asset class, including lending, credit, and portfolio risk, and that also spans lending operations and compliance, KYC, and AML onboarding. We bring every year new savings and efficiencies to our clients and assist organizations across the whole financial services spectrum, both the banking and asset management landscapes. Today's session is 60 minutes in length. We aim to do about 45 minutes of presentation and panelist questionnaire, and then followed by a couple of polls plus a Q&A segment. From a housekeeping perspective, we'd ask all attendees to ensure that their lines are on mute, and also as we go through the presentations and the questions you hear the answers from the audience, would appreciate if you could be holding your questions and then posting them to the chat box at the lower end of the Zoom bar. To kick off, I'd like to now introduce each of the panels. We felt it'd be useful to ensure that the panelists themselves were doing their own introductions. So starting from the very early in the US East Coast, we have Tony Smith. If I could hand to you, Tony.
Hello there. Good afternoon or good morning, depending on, I guess, where you are. Thank you very much for allowing me to participate. Yes, my name is Tony Smith. I currently manage the commercial underwriting portfolio as well as public sector, agriculture, and healthcare for KeyBank. I've got roughly 27 years in the financial industry. Prior to being in this particular position, I managed business banking, SBA, high net worth lending, was a senior credit officer for the bank, sold investments for the bank, have been in sales positions, etc. So, I've really got quite a history of being in many, many aspects of the banking industry, as well as working through various economic downturns and upturns, frankly, over the course of the last 27 years. So thank you very much for allowing me to participate this morning.
Thank you so much, Tony. And everybody else, you should also know that Tony stepped into the breach just today to assist us after a colleague was a little unwell. So thank you again, Tony, for that. Okay, I'd now like to turn to Brian Johnson, who's on the West Coast, even earlier, and has agreed to join us today. Welcome, Brian.
Thank you, Damien, and welcome everybody to this event. My name is Brian Johnson. I am Senior Vice President and Commercial Credit Division Director at Umpqua Bank. I have been with Umpqua for a little more than 2 years. Preceding that, I was with Wells Fargo for 35 plus years in various relationship management credit positions. And finally, in a role similar to what I handle at Umpqua, I was also involved with underwriting nationally for the commercial bank. In addition to the responsibilities of underwriting, I'm involved with strategic planning around operating efficiencies, credit policy, get involved with various other topics, but the core of what I do has been credit for my life.
Thank you so much, Brian. Now joining us from the UK, I'd like to introduce Nick Rustling from Investec.
Thanks, Damien. I head up portfolio management at Investec, looking after our specialised lending desks. That includes mid-market leverage finance, power and infrastructure, and fund finance. This is quite relevant for us at the moment. We're undertaking a project to capture all our key credit data on all individual transactions and then build that up into dashboarding to give us more insight and better early warning indicators on what's going on in the portfolio. Prior to Investec, I spent 10 years at Barclays in the debt finance team there.
Thank you, Nick. And lastly, from Acuity Knowledge Partners, we have two great panelists as well. First of all, Rachel Sood.
Hi everyone. I'm Raju Sood. I'm the Global Head of Commercial Lending Practice at Acuity Knowledge Services. Overall 18 years of experience, and for the last 16 years, I've been with Acuity, working with a number of corporate and commercial banks globally. Today, we've got more than 400 people supporting banks and financial institutions in the credit risk assessment across origination, underwriting, and portfolio monitoring. We work as strategic partners with banks and support them in their transformation and digitization initiatives. Thank you.
Thank you, Rachel. And now David Fellows, our Chief Digital Officer in London.
Thanks, Damien, and good afternoon, everybody. As Damien said, my name is David Fellows. Like Nick, I'm based here in wet and rainy UK this afternoon. I'm Chief Digital Officer at Acuity Knowledge Partners, where I lead technology, innovation, and digital transformation. I've worked in financial services for the majority of my career. I have a background in computer science, data science, and artificial intelligence.
Thank you, David, and thank you to the panel. Okay, we will now get into exploring the challenges of the ROI and digitization of this lending world. Before I do, I'd like to set the scene. I think everybody appreciates the substantial challenges and reshaping that's going on in the banking landscape, and I guess the broader shadow banking landscape as well, let alone the current situation with the COVID-19 and how that creates a change for markets and all of us as practitioners. We know banks generate a large volume of data and customer information, but also I think the question really that's posed sometimes is how much of this is being used to customer advantage, to business advantage, and are we really getting actionable insights from our customer data? And that really also kind of dovetails into also, is this data and other parts of the information cycle in lending also leading itself into the risk process, and I guess ultimately the full circle to providing us an improved ROI, but also risk perspective. Just one thing I'd like to add is that according to leading research, 88% of financial institutions believe that improving customer experience and data analytics and artificial intelligence is the two most important digital strategies for 2021 and 2022. And there are three things that Acuity believe are very important under this context: the adoption of digitization, reducing the overall operating costs, but lastly, building a data-led business that informs all aspects of the sales cycle and risk mitigation processes. So without further ado, I'd like to get into the first question, which I'm going to put to Tony. Tony, from KeyBank, being in underwriting and, as you've said, many different roles, and operating through lockdown, and then the government stimulus through PPP, and now into the loan forgiveness cycle, how do you think banks are responding to this new normal and managing the priorities at the same time?
Well, I think they're doing an excellent job, to begin, because so much has been thrown at them in such a short period of time. So, with everything that's occurred, PPP, the lockdown, contingency plans going into place, banks found themselves needing to support their customers first and foremost, because that was the most important thing, to make sure that the customer was getting what they need. We also needed that for brand, we need it for recognition and so forth. We had PPP come in on the back end of that. So, that was, the government requiring us to produce a large portion of lending in a very, very short period of time. And it meant that we had to produce that very quickly for that customer base. not only produce the lending piece of it, but also understand that with that stimulus, that forgiveness was going to be on the back end of it. And we were also going to need to approach that and be able to function through that in a very short period of time. All of this is occurring at the same time that we also needed to make sure that because we're in this economic downturn, we're spending a lot of time also focused on, frankly, our existing portfolio. So we needed to support that government program at the same time as making sure that we maintain focus on the existing portfolio and enhance that portfolio monitoring and maintenance that went with that. So, we're seeing clients that are declining, they're shuttered, et cetera. We've got covenants that we need to test, potentially make adjustments to, make sure that we're getting financial statements collected in a very timely manner, making sure that analysis takes place, managing payment defaults and deferrals at times. So we have all of this occurring at the same time as going into a contingency plan to have predominantly the bank's largest percentage of its employee base, right, work from home, and also have to continue to manage those relationships under that contingency plan where we're really, heavily, reliant upon technology to make sure that we can execute in that way. So when we think of all of the things that the bank has been up against in a short period of time, and to your original question, how are we responding to the new normal? I said, I think we've done an excellent job, but I think it has been that starting earlier in the process through those third-party partnerships, and frankly, our partnership with Acuity in streamlining our processes and having been in front of that in the beginning, that's actually allowed us to respond as quickly as we have, stand up those new procedures in short order, and frankly, facilitate that level of work that was required in such a very short period of time. If we hadn't been assessing our procedures, ahead of time and really been ready for that through streamlining, it would have been a different story. But a lot of that certainly, laid a very, very strong groundwork for us. So we've responded excellent. We've responded excellent to this.
Thank you, Tony. And maybe just for the audience, I just wonder what your perspective is on the loan forgiveness coming up.
Yeah, well, we stood that up for our bank on the 28th, and we opened that door with a very strong digital footprint to open that up. So we've been very reliant on our digital process in order, not just for PPP, for the lending upfront, because without that digital process, we would not have been able to, get through 42,000 loans in a matter of, really in a condensed time period. I think we processed 26,000 in a weekend alone. So without that digital footprint, we would not have been able to do that. As we open up into forgiveness, we're going to be equally reliant upon that digital process and using AI, using our systems in order to simplify that process, something that's really quite complicated for our borrowers, and simplify that process for them so that we can get through, this forgiveness for our clients and support them through that. So, strongly reliant still.
Thank you, Tony. And that theme of digital, I feel the need to bring David Fellows in. And I guess, David, the question for you is, how do you think technology can assist both now and in the future to assist in this workflow, but also to how to optimize the costs?
Yeah, as you've already said, Damien, and as we all know, 2020 has been unprecedented in all of our lifetimes. In the space of just a few months, many of the established norms that we've all lived by have just been all turned on their head. Like Tony just mentioned, where are we now? We're nearly in October, but it was only just back in March that we were all scratching our heads trying to figure out how to support our customers whilst at the same time enabling thousands of our staff to work from home. I think looking back from a technology perspective, there were probably two major trends that helped organizations manage an orderly transition of their workflows from office to home. The first one that I would observe is about cloud computing. Cloud computing made it simple, and critically, it made it quick to deploy secure solutions to users in work from home configurations, and then be able to scale up or down as required. The move to cloud computing by the banking industry, probably started by the team at Capital One, started relatively slowly, but it's now the predominant mechanism through which Acuity's clients ask us to deliver solutions. I would say that since the lockdown started, from a technology perspective, cloud-based solutions are probably the #1 thing that I've been asked for or asked for advice on by our clients. The second thing that I would observe in terms of a trend is the interoperability provided by application programming interfaces. All of us live in an ecosystem of IT systems, and I'm sure we're all used to those systems having various levels of interoperability with one another. In fact, I was on a call just last week with one of our clients, and he said to me, "Dave, when it comes to loan management systems, we have a legacy one of everything, and I spend pretty much my entire day trying to figure out how to get these things to sort of like to talk to one another." So the ability to link services together seamlessly without major risky IT projects is of paramount importance. Not only do APIs provide the ability to plug and play new functionality, but they allow organizations to avoid vendor lock-in and reduce implementation risk. If anybody on the call is considering implementing new technology systems as part of your credit process, I encourage you to make sure that your vendor has an open API strategy that will allow it to talk to everything else. But irrespective of the pandemic, the world doesn't sit still. We all have jobs to do, and now we're all kind of up and working. We must get back to innovating solutions to give ourselves competitive advantage. So if I had to kind of pick out one thing which I think will be which will enable companies to differentiate themselves, it's something that Tony touched on in her remarks. It's still about machine learning. Just a few years ago, the idea of using machine learning as a legitimate way to predict the future was still considered science fiction, but it's now very real. I think those companies who know how to deploy machine learning solutions to find the proverbial leading indicator in the gargantuan haystack of data that the world produces every second of every day, and then successfully integrate that information into real-time decision making at the point of business, are going to gain a significant advantage.
Thank you, David. Brian, I wonder if I could now bring you in on both the question to Tony and David and get your perspective and perhaps any other areas you'd highlight from your experience.
Sure. Well, certainly PPP and comments Tony made about being able to stand up or respond, that was a clear shock to our system. As context, banking in general, we have a number of competitive pressures out there. We're already faced with thin profit margins given our low interest rate environment. We got technology firms, non-banks out there introducing technologies that they don't necessarily face the same type of regulatory oversight that the banking industry does. But when you lay on the COVID situation where we're all working at home, we're having to rely on technology to communicate, and then the impact that has had, the speed and severity of the impact that has had on all of our lives, including our customers. That's going to continue to place stress on our business customers and our communities we serve, and therefore really kind of impacts bottom line for us. With that as a backdrop, I guess the three areas I would add to the conversation here that we have to think about is one is kind of what is in it for our business customers. To the extent we can build market insight and utilize transaction data, industry information, purchasing habits, and the like to leverage our knowledge of our customers. That gives us the bankers the insight to provide the right banking solutions in this time. Secondly, I would say from an operating efficiency perspective, we got to understand and optimize workflows in order to by selecting the right channels to put our customers in, so thereby increasing our speed to market and eliminating any redundant operating processes. then finally, I think which Tony hit on, the portfolio risk aspect. We obviously need agile and robust portfolio management capabilities so that we can look at information across platforms and quickly identify those emerging trends and risks in the portfolio. Technology investment is underway at Umpqua as well as many other banks. We've embarked on many of these things, but I would say we still remain in the early stages of some of this machine learning capabilities. Nonetheless, we do remain bullish on it, and we are looking at opportunities to quickly stand up and serving our customers. One of which, obviously, right now is we're dealing with the issue of PPP forgiveness, and that's been opened up to our customers and non-customers alike that applied with us. The ability to gather the information more simply and decision that information more simply. With the current low interest rate environment, I guess all lenders will probably be focused on technology, but it will be a very focused look because budgets will be limited by the amount, by the performance of the banks. So opportunities to either employ internally developed or outsourced technologies. We feel like we're in a good position to integrate this information and provide that decisioning. So,
thank you, Brian. And maybe if I could bring Rajul in now. I think from Rajul, your standpoint, your vantage point of assisting many customers across multiple different jurisdictions on workflow and transformation, what observations would you make in terms of these digitized efforts, and maybe touch on what you see working and not working across that spectrum?
Sure, Damien. Damien, the pressure to digitize in a big way is actually very real. The time it takes to onboard a customer is extremely high for some of the banks, and you'll be surprised that for some banks it almost takes about 25 to 30 days to onboard a customer. And these delays have further increased due to pandemic, with the world going completely online. And to add to it, the bank's siloed structures are not helping and overall increasing the cost to serve for the banks. However, this pandemic, as well as the initiatives for transformation, has created a lot of realization also in banks to digitize, bring in efficiencies in the processes, and reducing cost to serve. Today, almost every bank has a digital ambition, but we have to remember that the implementation requires people with domain knowledge. So, what we see with most banks is that the initiatives are either dependent on the front office teams or the credit underwriting teams, who are also busy turning the engines for the banks, especially like Tony said and like Brian said, with programs like the PPP in the US or the CIBIL in the UK. But one thing I would like to mention, it is most positive change that has been happening over the past 4 years and has been helping the banks in their digital journey, is the acceptance to strategic partners who can bring in best practices of the street, who can bring in innovation, bring in technology that can easily integrate with the multiple lending systems and processes. Essentially, there was a traditional paradox about 4 years back, and still with some of the traditional legacy banks, about strategic partners in the credit analysis process due to loss of customer knowledge or sharing credit DNA. But what we've seen now is that there is a realization for a more cost-effective centralized team who can not only free up front office time to do more client differentiating work, but also help banks speed up their digitization journey. Everyone now realizes that eventually most manual processes in the credit cycle would be automated. So there is larger acceptability, and there is a slow cultural shift that is happening in what we are seeing.
Okay, thank you, Rajul. And Nick, maybe I could turn to you now, bring in the European and UK flavour. I know from a specialist bank, Investec, I'd love to get your opinions in terms of the challenges you foresee in that digitised lending. I know we don't have the PPP type programs, but the low interest rate cycle and the risks thereof, I guess, are similar globally.
Yeah, I think banks, we have quite diversified loan books, and we've got a series of non-standardized systems that I think David alluded to don't necessarily speak to each other easily. And we've also got processes where we don't really hand off information between each discrete part. So if I take sort of the life cycle of a credit journey, on origination, I think we tend to originate where we have people facing a customer set rather than necessarily mining our book and the data and understanding how the clients behave and what would be the best sort of risk for us to hold from a returns perspective and efficiency perspective. During the approval process, we have discrete functions where we get the same data but not necessarily handed off between each other. So we'll get to a structure chart for a KYC purpose, and at the same time we'll get the same thing off the client for a credit paper. Financials, we have them inputted into a credit paper but separately manually inputted into an internal ratings model. And then you've got a legal process where you've got key commercial terms documented in-house, and then you go to external lawyers, and we start from scratch rather than having a seamless flow into the documentation. And then as we monitor the clients, we're still in a world largely paper-based financial covenant compliance. So, you know, out of that picture, I think the key challenge is you've got legacy systems where the information is essentially trapped. You've got a cultural challenge because people look at processes in terms of what people are doing rather than in terms of a flow of information. And if you flip it on the head from the flow of information, it becomes much more of a journey of that information through the systems. And then suddenly in the space we're operating in, it's a multi-bank world, and some of this stuff would need cooperation across the market to actually move how we do things. So I think on where the focus should be, it's on ripping out all your legacy systems and creating one sort of all singing, all dancing system. It's getting the systems to extract information and having an overall system above that where you can report across every bit of information that you have. And I think capabilities banks should focus on when they have that is understanding where we are most efficient at originating. It's setting up processes for early detection of credit events, credit deterioration, to get us involved early. And then some of it can be actually about the client experience. You know, there's a world where it's possible for the client to have a pretty slick experience where they give us information just once through an online tool, and that actually populates our KYC process, some of our credit process, our internal rating process, and they're doing our work for us and they don't even know it. They just think they're getting a good experience.
So thank you, Nick. So quite a lot of efficiency gains and potential to improve the ROI, but equally it sounds like there's quite a heavy investment burden that also has to come along at the same time. But maybe just to ask you a follow-up question, you know, do you find it hard within your own organization to get the investment focus on those challenges?
Hard initially, where it's, you know, it's a one-off cost in the environment we're working from and where it's time from people. I think people fully buy it when it's shown as an investment that actually yields that efficiency, and it gets people in a bank doing what they should. It gets originators focused on originating. It gets credit officers focused on analysis and actually understanding, and that's the conversation you need to be having rather than just around the upfront cost, I think.
Makes sense, Nick. Maybe I could now come back to Tony, and maybe peeling the onion, so to speak, a little deeper into your experience in both the underwriting and portfolio optimization. You know, how do you recommend banks should be thinking about that optimization and also the monitoring process, and to make it the most cost-effective execution process?
Yeah, so, you know, Nick, Brian, Virgil all touched on some really key parts and things that banks, you know, are up against as we think about our different systems, our different swim lanes for processes, you know, the redundancy of work and so forth, that is just embedded within, you know, our historic banking, we'll just say operations that come along. So I think the best place for banks to start, and certainly is, you know, this is going to be maybe a little bit of a longer answer, but you have to start by understanding, you know, the bottlenecks that are in place right now for your existing processes and procedures and your inefficiencies that you already have. You have to really understand what you have before you can move forward. So when we think about questions that you can start to ask yourself in order to improve those processes, you can think about, is there a need for credits to follow the same process? You know, do we have to treat it all the same? You know, or does it even have to be different based on risk perspective? So you want to start there. You want to think about timeframes, you know, for annual reviews and the completion of different pieces of the process. Do they have to be, you know, annual reviews have to be separate from renewals and so forth? Again, looking at your process and procedure. You know, we have to think about what factors are within the control of the banks to manage. So more frequent reviews for high-risk credits, using trend card analysis as early warning signals to decide which exposures should be high touch or low touch. You know, this is important when we really think about the credit risk perspective of the portfolio, and oftentimes how we've kind of separated out how we treat things based on maybe where the line of business, where they've originated. We've got a lot, you've got to think about the duplication of effort within the process, and where can we streamline and get rid of multiple touches, really re-up separate departments doing the same things. And as I mentioned before, you want to think about your timing and how often you touch a client. So whether it's annual reviews and renewals, and how much can be condensed down, you know, into that. That's a lot of where we started to really outline understanding what do we really have today. We tend to live in our own swim lanes, right? Where we understand just our line of business, but it really matters that you understand fully how your bank is monitoring its overall credit portfolio, and understanding all of those in order to really be able to start condensing and simplifying the process. So, you know, for instance, when we partnered with Acuity, we started to, and I think it was maybe Brian who touched on this, you know, we started to segregate our workflows with respect to, rather than having one person do it all, so our underwriter really being responsible for pulling in the documents, for, you know, doing the spreads, et cetera. We have teams now set in place for that. So having that work segregated by work teams was really important to simplify the process, because we allow people to focus on areas that are specific and really be experts in that area, while all joined together and working seamlessly through an event. So we have document managers, we have execution teams, underwriting teams, project teams who are really locked arm in arm to work on a client, but it allows people to focus on what's very specific and important to manage the risk. So also simplification of our interim review process by merging our risk rating model and automating that process was important. So wherever we could get rid of the manual, you know, having a task and a body have to type in numbers and have those, you know, technology feeds to populate modeling systems and so forth, we've seen, you know, an increase, you know, in our ability and bandwidth, you know, in shortened turnaround times for those items, so that they, you know, open us up for managing the risk in other ways. So wherever we can introduce technology to simplify those processes has been very important. You know, we have a really seamless workflow management. Everyone knows their process, their procedure, what their role is in it, and we make sure that we're working tightly together, keeping communications open so that, you know, we don't have silos. You know, blowing up the silos is very important, that everybody understands that we are dramatically attached in these processes and we don't live on an island. So that seamless workflow has been very important. And, you know, one other item that we've done is just the streamlining of our templates across our credit write-ups and our monitoring. You know, in the beginning, as I mentioned, we tend to live in these again, silos where everybody has their own process and procedure for a line of business. At least that's what we found. And as we started to understand exactly what we had and be able to identify the redundancies in that work, and at times even question, was our approach really the best approach to manage the risk based on the exposure and based on, you know, even where it's at. Because, you know, $1 million line of credit, whether it sits in a business banking line of business or a small business or commercial, is still $1 million line of credit. So we really shouldn't have separate procedures just because it came through a branch or just because it came through business banking. And that ability to really streamline our credit write-ups and our monitoring process and start to nip away at those independent process and procedures, again, created a really streamlined procedure and process overall for the bank for us, where it created, again, that bandwidth that we need. You know, is frankly, the banking world becomes more globally, you know, intricate and demanding of its needs, and our clients become more demanding of our response time, frankly. So those things have been very, very important for us. Centralizing our portfolio monitoring has been extremely important. And I mentioned this from the beginning, you know, having that centralization, of course, it always comes with a little bit of nervousness in the beginning, right, that people have because it's different. But it has been, you know, a fundamentally life changer for us in our process and procedures, because we have a team that's focused solely on that and can effectively do the monitoring for us. We're, again, dramatically attached with that. It's created that bandwidth for us. And even that time difference has worked out to our advantage, because, you know, I could have something at the end of the day where I send it off to my team, my teammates at Acuity. I come in the morning and that task is complete. So I'm able to respond to my client in a much more efficient way and have that process flow much more efficiently, because I have this centralization of these items that are so important to that ongoing monitoring, and creating that bandwidth for the core underwriting team to focus on, you know, those immediate client demands.
Thank you, Tony. I think on the same theme, you heard several elements of bandwidth and also just how hard this process is. And I think it's clear everybody has their day job before they're being asked to do many of these types of functions within banks. So I think, turning to you, Brian, you've got a lot of experience in this area. I'd like to kind of understand, you know, that issue of, have you got enough bandwidth and resource, but really dovetail down into, how do you think analytics can be used to develop these early warning indicators for both credit resiliency, but also future credit risk horizon events?
Sure. Yeah, and I think Tony's comments about kind of looking at the process and identifying areas that can be centralized effectively, it really speaks to kind of putting people's talents to the best use, whether it be underwriters, bankers, or the like. And so finding those abilities to kind of professionally and proficiently operate various segments of the business are important. I think the other thing I would just say, just tack on, and then we'll get on a little more to the direct question, but you know, customers really don't care whether, you know, we're at Umpqua's business bank or commercial bank or corporate bank. All they see is Umpqua Bank. And so very much similar to what Tony is saying, is we got to be customer agnostic about it, and just think about it. How do we process this in an efficient way behind the scenes, so that all that the customer sees is, you know, a success in what their ask is. You know, from an analytics perspective, I think the core and kind of where we're dealing with kind of technologies to improve things are on the data side of things, and just having clean data. We find that as we start looking at information across platforms, you see anomalies, you see things that are different. And I think that's at the core of everything we have to do, is get to the point where, you know, we have systems talking, we can remediate data, we can then use that data more effectively to decision what to do with a particular situation. Otherwise, you're just dealing with garbage in, garbage out, and it's the decisioning process is flawed. So, you know, I go back to kind of my comments earlier about kind of maybe three areas. You know, it's kind of the service channeling. You talk about credit scoring versus kind of a traditional underwriting model. Can we get to the point where the data we have on our customers and our potential customers provides us with insight as to what is the best place to put this customer. Creating paths for servicing them, or whether those paths are pure scoring, whether they're a light touch type underwriting, or whether they're a full-fledged underwriting. Really depends on the exposures, the type of industry they're in, and the like. And if we could do that effectively, I think that allows us to align the customers in the right channel and decision their requests in a quick and orderly manner. From a risk rating perspective, we have invested a lot of time over the last couple of years in risk rating modeling, and it obviously has implications for our loss provisioning and swift portfolio remediation. In the traditional sense, lenders, banks would rely on banker judgment to, get financial statements, look at financial statements, judge whether the risk rating of a customer is, good or bad, if you will. That really, speaking back to the COVID issues and just the speed and severity which that all occurred, that's somewhat of a flawed model because you end up, being delayed in those decisionings. You're taking a stab where maybe you shouldn't have to. So what we found with our risk rating models, it actually performed very much in line with what was expected. Using life cycle modeling, we can see kind of what industry, what geographies, what product types were being impacted by what is arguably the most severe downturn we've seen in our lifetimes. Now, there's still opportunity on that for improvement, I would say, but definitely we saw that, and we can now look forward a little bit more and say, okay, based on this information, we can see kind of where the holes are going to be. From a portfolio monitoring perspective, I think there's opportunities, and this is, we're early in the path with our work with Acuity. We just engaged them with centralized spreading at the beginning of this year. We're starting to have those thoughts and conversations around covenant monitoring. And we see situations where gathering that covenant data across customers. Not only, it doesn't only provide the ability to evaluate a customer by customer situation, but it allows us to look across business types or geographies and product types to say what is maybe the most effective covenant packages that provide us the best chance for early warning for our portfolio. And then if we can extract that data and integrate that with our loan management systems, that certainly reduces those keystrokes that Tony was talking about to get to the point where now it's just embedded in the process and people can focus on what they do best. I think there's more opportunities for integrating external information into decisioning tools, whether it's scoring, custom underwriting, or risk modeling. And I think all of that, when you kind of add it together, we kind of undergo this change, if you will, allow us to make those timely and informative credit decisions.
Thank you, Brian. So a substantive amount of credit risk modeling, as well as analytics, and driving a new sense of data insights that we've got today. And I guess I've heard also the challenges with the swim lanes, and also just bringing people together as one culture, one bank across both of your organisations. Maybe if I could turn to Rajul, because I know one of the important elements of considering an external partner to advise is also about how do you assist on the governance of all of the program types that we've just heard about. I wonder if Rajul, I could come to you just to talk a little bit about that, improvising and improving risk governance frameworks.
Sure, Damien. So Damien, many companies, if you go back to 2008 crisis, had to rebuild their risk and financial models, which actually failed. Similarly, there will now be a need to replace models because of the massive economic and structural shifts that has been caused by the pandemic. And whether you talk about supply chain disruptions, you talk about changes in industry and country risk matrix, you talk about volatility in capital markets, or a potential recession. There are a number of things in the minds of the credit teams today. And in response to these crises, and mostly what Nick and Brian already mentioned, these institutions are beginning to approach underwriting and monitoring with a new configuration of sector analysis, early warning signals, and high frequency analytics. Let me give you a few examples. And it's exactly in line with what Nick, Tony, and Brian has been speaking about, the kind of reporting they're looking at. The banks we're speaking with also are looking for automated dashboards using financial and reporting governance, providing early warning signals for deteriorating covenant quality. They're looking at regional and sector level dashboards that sometimes even reduce to subsector and obligor level. They're looking to create shadow rating models with sentiment analysis covering key market and sector events, and the slightest impact in the market would sort of give them a view of their portfolio or the ratings. And not only this, banks are actually lately using data aggregation tools so that the relationship managers who are facing the customers have like more up-to-date information and risk monitoring scores right on their fingertips, including if you talk of financial performance, industry performance, market data, news, and so on. They just want their relationship managers to have a very good conversation with the clients and spend more time in facing the customer. And not just for speaking of banks and relationship managers, categorically, if I talk about regulators, most of the SNC audits and the regulator reviews that are happening, the expectation is to have a clear audit trail right from a borrower level risk assessment to the portfolio level risk assessment, and analyzing the trends and deviations over a period of time. So finally, I will say, Damien, now that the economy is in crisis, data and analytics lies at the core of banks' credit risk assessment.
Thank you, Virgil. And the time is flying. I hope this is very interesting for the whole audience. Certainly very interesting being part of this engaging panel. Just before I turn to Nick with what probably will have to be our final question to our panelists, I'd like to just remind everyone there's a chat box at the bottom of the page. If you could actually just, any questions that you haven't thought of yet or any that you do, please just remind you that you can pose a few there. We'll have about 10 minutes, I think, for questions. And we will promise to get back to everybody with any questions that haven't been answered as well. So Nick, turning to you, you've heard a great deal of information flow there, from analytics to risk governance to different macro trends in different parts of the world. I wonder, Nick, from your perspective, how do you believe AI analytics is going to help the banking landscape? A lot of people talk about it. They use the AI word. We sometimes joke it's augmentation from India, which is from our organization. But will data science really become into the fore in 2021 for every organization, and will it receive the right investment dollars?
So if I think of the sort of credit time that we spend at the moment, it's largely based either aggregating information around a risk management cycle, so annual reviews or reviews of risk limits. And then on an individual client basis, it revolves around sort of having a panic when something approaches a financial covenant level and taking action then. And I guess there's probably only 20% of the time is actually outward looking, what is coming down the line and what can we think about in the future, how can we be proactive. And I see, data, AI, digitization, whatever we want to call it, it's flipping that on its head. And you've got 80% of your time is actually looking forward and how do you manage things on the front foot. So if I think around what that would mean, and at the moment we're largely in a financial controls and triggers and things that we're looking at. And we generally, in the corporate world, we're looking at EBITDA, proxies for cash flow. And it's how do you catch what's happening there much earlier. So you're not just looking at a covenant based on EBITDA, you're looking at what feeds into EBITDA, sales, gross profit, cash conversion. As we go down the line and get more sophisticated, we look at key suppliers and are there problems with key suppliers or customers, because eventually that'll impact our clients. Everything we're doing is just pulling our intervention or our knowledge of what's going on forward from the actual breach, when we find out a month before it's obvious it's going to breach a covenant, and then we try and waive it, and then we try and come up with a plan. It's all a bit reactive at the moment. And then really non-financial risks, because these are the things that these are the things that hit us more. So we've got an aviation lending book, and we all act like it's pretty unusual now that no planes are flying, and it is a very extreme scenario now. But in recent memory, planes have been grounded for a significant period of time, 3 times fairly recently: terrorism, the ash cloud, and now COVID. And do we really think about that proactively? Did we really model what that impact on our book would be? Obviously aviation lending, but you've got hedging, you've got fuel hedging, you've got corporates who serve the aviation or tourism industries. And I see digitization as a way of giving us the time to think about that kind of thing, and also giving us the insight to quickly sort of model what the impact of that would be. And I guess the last sort of element that's sneaked in there is it going to get the investment it needs? Well, I think 2 things out of this. One, it shows that type of thinking on something huge that has a huge impact across your book can quite easily happen. And pandemic was on government list. It was on something that is very possible and could happen, and it's right in our face. And now we are all in a world where we're interacting with technology, and we cannot do our job without technology in a way that was very different to before. So I do think it gives a big impetus and accelerates things that were happening anyway.
Thank you, Nick. Well, thank you to the panel for all that you've added to here, and I hope it's been very interesting for the attendees. We're now going to go to the Q&A, and Nick, you'll be pleased to know that you hit a spark there. And first question to you. You work in a niche market, but in London, so there is probably a wealth of data to which to build models and gain the rights. I work at a bank in South Africa in the same niche corporate and institutional segment. In our context, there is only limited data available for us to model, with very few defaults usually out there. Just want to get your perspective in terms of what you do in such a situation.
So I think if it's trying to find evidence of default, yes, there is more data around what we do, but it's not that unusual an experience, because Investec's a small bank without a huge balance sheet behind it. So we often compete in niches, which creates the similar problem that you've got in a market without the depth of London, that you don't have the evidence of track record, because by the nature you're doing something that hasn't been done in a way that's been recorded quite as frequently. So things we try and do is sort of create the nearest proxy from the data that we do have to get a track record of default. If I give an example of what we have a fund finance lending book, and touch wood, there has been limited to no defaults that we're aware of in that space. But what we do is look for proxies that correlate with that credit risk to try and understand what that default would be. So for that, you've got investors who are institutional investors. So what's the track record of default there? And it's generally funds who are private equity funds. So you can look at the track record of performance of PE funds for the likelihood of the funds themselves not returning enough to investors for the investors not to fund that. So it's really about building up the nearest comps that you do have, but recognizing within that there are limitations. So you have to add a level of conservatism over the top to account for the assumptions that you have made.
Nick and Rajul, I know this is a subject close to your heart. Would you like to just add to that?
Yeah, I'll probably agree to Nick, Damien. I mean, you'll probably have to create a more comparable peer analysis, but also, what we have seen banks doing is whatever available data they have, I mean, look at that and then complement it with the sentiment analysis, as I was talking about, building shadow rating models and building the impact of certain market events that would typically affect that industry, and then at a borrower level, it will also impact the ratings. So essentially, looking at the sort of segmenting the industries or markets for particular businesses, and then possibly applying how the market reacts to certain events, and looking at how the industry is doing as a proxy to your business. So this is, I would say, mostly in line with what Nick said.
Thank you, Rajul. We have the questions flowing in, but we probably don't have too much more time I'd like to provide one to Brian. He is coming in saying, using the life cycling of modelling, do you believe severe credit events with long-term impact can be modelled appropriately?
I guess the answer is yes. In fact, I think we got a real life test here with the risk modeling that we have in place when COVID hit us. I mean, in a matter of 30, 60 days, we're talking about economic events, basically shutting down business, and that information was part of the models the model that we use for risk rating. That preceded any new news from customers, whether it be financial statements like that backward-looking thing. So just by its own nature, using that economic modeling, using economic impacts, it very much allowed us to kind of see what was going on in the portfolio across geographies and the like. It still relies on a combination of quantitative and qualitative inputs, but clearly, very clearly, the economic modeling behind the scenes is what it tells us what's going on in the portfolio. There will be refinement. We're going to have to look at the tolerances, because I think we probably shot too far one direction because of the economic models, and now we're seeing it come back the other way as things start opening up again. But that was clearly a pretty significant and pretty eye-opening event that we just went through.
Thank you, Brian. And one last question here to try and finish on time. Maybe I could put this to Tony. You mentioned using third parties and augmentation. We've had a question, how do you get started? Where do you start, so to speak? And I think it's probably most appropriate, Tony, that you could kind of outline some of the success points, but maybe also some of the things you have to worry about in that process. Sorry, Tony, just need to unmute.
My apologies there. I thought I was. As I mentioned before, I think you really have to start by understanding what you have already in place, is that starting point, and understanding, your true process and procedures and the amount of touches that are already in place, for those different process and procedures. You have to start there before you can even start the streamlining, of those overarching procedures, right? So, I think you asked, where to begin, and then maybe even what some of the risks are. I would just point out that moving towards that centralization, moving towards streamlining those processes, and moving towards, using AI or technology within your procedures, it's more of a not moving in those directions is more of the risk than moving in those directions. In order to survive, really, it's incumbent upon the bank to be thinking differently around how we approach our portfolio and the work that we do and our underwriting, and really leaning on technology and, having efficiencies within our procedures in order to really compete in this global market. So, I think the risks are really that you're not moving in that direction, and you're going to be passed by if you don't. So when I think back to, the steps that we've taken at Key to have that centralization of the portfolio monitoring, really doing that and taking those steps has opened up a lot of doors for us. Not just what I mentioned earlier around the bandwidth that gets created with that, but also it's really important because you've opened yourself up to having, this really dynamic team that you're working with that sees on a broader level, globally what's possible, and they can introduce those things into your own organization. So it's bandwidth that you're creating, it's streamlining, it's condensing, it's allowing you to get in front of the client faster, being more competitive, important with your brand and recognition and so forth. And, really it broadens your perspective of what's possible. So I hope that answers the question, thinking about what you have right now, condensing it down, how you can simplify those things and stop having redundancy, and then partnering to really utilize the technology and the systems that are out there today now with so many partners, dynamic partners, to really help improve yourself for the future.
Thank you, Tony. And that really brings us to the end of the webinar. We're unfortunately out of time. The number of questions that we've got, we could actually have probably gone another half an hour, but as promised, what we'll do is we'll make sure that we provide those answers to your questions, and also look out for any future themes in the webinars as well. So thank you again to the panelists for taking the time. I'd also like to thank the Acuity team for making this happen. And more importantly, I'd like to thank everybody that dialed in today to hear something on the transformation and ROI process and digitization, that you got something valuable from it. So thank you very much, everybody, and have a great end to the quarter, and stay safe. Thank you.